We're taking a look at the investing landscape with Mark Newton, Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy. And Mark, in a note yesterday, you were talking, even as the S&P 500 was up there at a record, you said we could see some consolidation here. So it looks like we're seeing that consolidation today. What happens now?
Well, a lot of it depends on your time frame. I mean, in the near term, you could see 3 to 5 days of consolidation. I don't really think we're going to see a whole lot of selling happen right now, specifically because sentiment is actually so guarded and bearish. People have become distracted with a lot of the tariff talk and the potential rise in inflation. And, we see polls like NAAIM, the name survey for institutions, the active institutional managers that has pulled way back in recent months from over 100 down to near 75. AAII is a retail poll, still shows about 11 percentage points more in bears than bulls. So with a market that just hit new all-time highs yesterday, when you look at the S&P and QQQ, I think that's really, really interesting. It's one of the few years where we've come into the year, and yes, it's been a choppy year. However, sentiment has been pretty pessimistic at a time when indices are near all-time highs. So I actually think that's very encouraging for investors.
And Mark, your Fundstrat partner, Tom Lee, he had a note about how you should never short a quote-unquote dull market. So can you explain what makes this current market dull and how that could maybe actually be a good thing for investors?
Well, the market's been largely choppy and almost unchanged for the last 2 months. And so we did see initial all-time highs happen into November, but despite the S&P and the Qs, and we see equal-weighted S&P, the Dow, the Russell, the Dow Jones Transports, the NASDAQ Composite, none of those are at new all-time highs. So many of those have lagged and are showing divergence. Oftentimes that means that we need to see sort of a catalyst to see this broad-based rally really start to materialize, and I don't think we're quite there yet. However, we have seen a pretty decent downward trend in interest rates on the long end, as well as the US dollar, and both of those are very conducive towards risk assets and thinking that we can push higher. It's almost exactly the opposite of what everybody's saying, that the new administration is going to cause rates to scream higher with the yields above 5%, the dollar is going to go up. Well, all of those things happened last year. Now we're seeing exactly the opposite. And so it might be something just to consider that, there are some things that offset the inflationary impacts of tariffs, meaning higher crude production by 3 million barrels a day, along with OPEC Plus turning on the spigots. That's going to cause crude to likely fall to 50 or below. And I also think that China's weak recovery, we've seen a pretty fragile rebound thus far. The equity market's rebounded, but the real estate market certainly hasn't. So China has a very big potential to export deflation to the rest of the world that would certainly offset a lot of those concerns. And we can't see used car prices and insurance continue to rise at the same levels we have in recent months. And so I take the other side of inflation's going higher. I think yields are on the precipice of a large decline in the next 4 to 6 months, which means, the 10-year can get down, not only down to 4.10, but likely crack that 4% level. And so that's going to be very encouraging for a move back into growth, into technology, and to think that the market can do just fine.
What about all the spending that this administration, perhaps in its next phase is going to be pushing for, whether it's tax cuts or some of its other fiscal measures? Does that mean that, that 10-year at 4%, that its days would be numbered at that kind of level?
Look, spending has been a big problem over the last, arguably, 7, 8 years. And I think that's definitely something we have to come to terms with at some point. There's no easy answer on how to really rein that in. I think we're all hopeful that we can see, progress potentially with what Doge is doing. But honestly, that's a first step. Those aren't things that immediately affect the stock market per se in the short run, but certainly are very legitimate concerns about what's going to happen with spending. Extending the tax cuts, are thought by some to, okay, that's going to be a big increase in money that comes in. However, it's also a very big negative in a lot of ways if we allow that to expire. So, we want GDP to be higher. We want people's taxes in general to be lower so that companies can, hire and it leads to job creation. So there's a lot of, you can choose either side you want, but overall the spending is a big deal with the deficit now at $37 trillion and interest on debt having to be refinanced at rates that are much higher than they were 2 years ago.
So over the long term, you're bullish on tech. You alluded to that move back into growth. But in the short term, especially year to date, we haven't seen tech outperformance as we've been used to, especially when you think about those Magnificent Seven names. Nvidia earnings are coming up. If Nvidia is not the top driver within this stock market, at least right now, what is? What sectors and what companies are you looking towards?
Well, I do think the Magnificent Seven has turned from the Mag 7 into the Lag 7, over the last couple of months. However, I don't expect that to last too long. I do suspect that most of these tech stocks are going to start to reignite and push higher. We started to see that with Microsoft just a couple of days ago. Microsoft's been in a range almost for about a full year. And so it hasn't been the stocks like Microsoft which have led. It's really been the Meta platforms, the push into software, at a time when semiconductors have been lagging. So we've seen that move into Palantir, of course. And yes, the last few days, we've seen a lot of stocks start to sell off sharply for reasons that maybe the fundamentals don't justify. And so technically, many of those should be buying opportunities. But when you say what's been working, a lot of it's been the banks, not only here, but also in Europe. It's been the primary driving factor of really why a lot of European indices have managed to outperform US stocks so far this year. It's been a falling euro, and it's been really financials being in a very good spot with a lot of these banks that are outperforming. And so that's happened not only in Europe, but also here, stocks like JPMorgan, Berkshire Hathaway, and the like. So I'm actually very encouraged by the financials. Industrials also have outperformed, and people thought this sector would get hit hard on tariffs, but we've seen stocks like Deere and Caterpillar, some of these machinery names that have a lot of asset revenues coming from overseas. They've actually managed to thrive during this whole time. So I think there's a lot to be happy about, and I think investors really need to ignore a lot of the exogenous events until they start to affect the stock market. And the stock market right now looks like it's operating, with a lot of things that are working that need to be working. That meaning technology coming back, the best performing sector in the last week almost. Financials, industrials, discretionary. We're finally seeing the consumer return to the market after last year, which it was absent. So, I'm optimistic at a time when sentiment is very guarded, to say the least.
I want to ask you specifically about Nvidia for a minute here, Mark, because we're going to be getting the earnings from the company next Wednesday after the close. We were crunching the numbers here today at Yahoo Finance and found that, Nvidia accounted alone for 20% of the S&P 500's gain last year. This year, it's only 5% thus far, and it's been underperforming the market. Is Nvidia still that big, broad market catalyst that it was at one point?
I certainly think so. That when you look at the market capitalization and how much Nvidia commands of the S&P and also QQQ, and so to your point, it has lagged a bit in recent months. It's been more sideways. Still, stocks like Nvidia, along with Taiwan Semi and Avago, those are some of the top stocks within the entire semiconductor space. But you only have about 3 of the top 10 outperformers within the S&P that come from the Magnificent Seven. It's been pretty broad-based and spread amongst many different sectors. You have many of the financials. You have Walmart participating and showing great gains. So I do think Nvidia is important. We heard from the conference calls of the Metas and the Amazons and the Alphabet, how much they all reference Nvidia in their conference calls, saying that yes, you're doing lots of capital spending and a lot of money is going into Nvidia. So there's continuing to be very high demand. I think that it's going to outpace supply. I don't think this company and this stock is going away anytime soon. So I like Nvidia. I don't care to guess as to what earnings will be, but honestly, the stock has had a very decent rebound in recent weeks at a time when many had given up on it based on DeepSeek, and now it's really started to show much better strength. And for me, as a technician, that's encouraging.
Well, we'll see if indeed earnings prove to be a further catalyst. Mark, good to see you. Thank you.
Likewise, great seeing you both. Thank you.